So you look at the S&P 500's performance this year, and on the surface, things look pretty good. But the analysts over at Apollo Global Management are sounding an alarm. They're saying that headline number is hiding a massive secret, a deep, K-shaped divide that's literally splitting the market in two.
I mean, this metaphor just hits the nail on the head, doesn't it? It perfectly captures these two completely different realities happening at the exact same time. On one road, you've got the booming tech giants just flying by, and on the other, you've got these traditional, old-school companies basically stuck in the mud. This isn't just a clever image, it's a perfect picture of what's happening inside the S&P 500 right now.
So what's going on here? Well, experts call this a K-shaped economy. Just picture the letter K in your mind. After some kind of downturn, you have one part of the economy that just shoots straight up. That's the top arm of the K. That's your winners, your tech companies. But at the same exact time, the other part slopes down. That's the bottom arm. And that's all the traditional industries and workers getting left behind. It's a fantastic recovery for some, but a real struggle for everyone else.
And here's the crazy part. This isn't just about, some households doing well and others not. This whole K-shaped thing is now creating a tale of two economies inside the S&P 500 itself, the very benchmark we use to measure the health of corporate America. If you just glance at the headlines, everything seems awesome. The S&P 500 is up a solid 15% this year. But let me tell you, that number is basically an illusion. It's hiding a major weakness that's affecting almost every other company in the entire index. Okay, so here's the secret, the thing that's skewing the whole picture. Almost all of that growth is coming from just 7 companies. I'm talking about the giants, the big dogs, Apple, Microsoft, NVIDIA, all the names you know as the Magnificent Seven. Their incredible performance is propping up the entire index, while the other 493 companies are, on average, actually getting left in the dust. And look, this isn't just me talking. This isn't some random theory. This is a serious warning coming from the folks at Apollo Global Management. Their chief economist, Torsten Sløk, has been tracking this trend for a while, and he's flagging some pretty serious risks ahead. And this chart? This is basically the smoking gun from Apollo's research. Just look at what's happening to profit margins. For those Magnificent Seven, they're climbing up and up. But for the rest of the market, the other 493 companies, their profit margins are actually falling. This, right here, this is the K-shape, visualized perfectly.
And of course, that gap in profits? It shows up big time in stock performance. The top tech stocks, fueled by the whole AI boom, are absolutely soaring. Meanwhile, the rest of the market is actually in the red, on average, getting hammered by inflation, tariffs, and a slowing economy. I mean, the difference is just night and day.
Okay, let's make this less abstract. To really see how this is playing out in the real world, let's put a giant from the top of the K right next to a classic company from the bottom.
So first, let's look at a clear winner, NVIDIA. Wow, their stock is up an absolutely mind-blowing 150% this year alone. And why? Well, it's simple. Their computer chips are the engine driving the entire AI revolution. They're not just riding the wave, they're basically the ones building the surfboard for everyone else. And now for the other side of the K. Let's talk about John Deere. I mean, it doesn't get more classic American industry than that, right? Well, their revenue in the second quarter dropped 9% from last year. So while NVIDIA is building the future, Deere's getting hit by the harsh realities of today's economy. You couldn't paint a clearer picture of this divide. So what's going on here? Why is a powerhouse like John Deere struggling? Well, it's really a perfect storm. Their customers, the farmers, are getting squeezed by high costs. Then you've got tariffs that are making materials like steel more expensive. And on top of all that, you have rising loan defaults, which shows that the traditional backbone of the economy is under some serious pressure. So when you see this huge split, it naturally leads to a much bigger, and honestly a much scarier question that Apollo is asking, is all this excitement around the winners creating a dangerous bubble? And yeah, this is the question on every single investor's mind right now. Are we seeing a totally rational excitement for a technology that's going to change the world? Or are we just watching a massive AI bubble inflate right before our eyes, one that could eventually pop? And this is where the warning from Apollo gets really, really serious. Their chief economist isn't just saying it looks like the dot-com crash of the late 90s, he's drawing a direct line to it. He sees the same patterns, trillions of dollars just pouring into a dream, often without any real profits to back it up. And we all remember how that story ended. And you can see the signs of this frothiness everywhere you look. You've got techs signing bonuses hitting $100 million, startups getting these massive $14 billion valuations before they've even turned a real profit.
It all just feels a little too familiar, right? Very 1999.
Okay, so we've got this deep divide in the market. We've got this potential AI bubble risk. What in the world are you supposed to do about it as an investor? How do you even begin to navigate a market that's being pulled in two completely different directions?
All right, so here's the game plan. First up, balance is everything. It might be tempting to go all in on the high-flying tech stocks, but you really want to mix those with stable, value-oriented companies. Second, learn to spot the red flags of a bubble, like a sky-high price-to-earnings ratio. Basically, that tells you how much hype is baked into a stock's price, and Nvidia's is over 70. Just for perspective, that is really high. And finally, diversify. Look beyond just the S&P 500 to help protect your portfolio.
And all of this really brings us back to one final critical question you should be asking yourself. The S&P 500 is clearly split. The K-shape is real. So take a look at your own investments. Which arm of that K are you riding?